All right, welcome everyone to This Explainer. Today, we're basically going to act as your virtual whiteboard to totally demystify financial statements. Have you ever stared at a trial balance and thought, okay, what on earth do I do next? Well, you're in the right place. Because today, we're zeroing in on exactly how to calculate those super tricky year-end adjustments. We're going to get into the real details of the calculation part, taking raw numbers, applying the strict accounting rules, and building perfectly balanced statements from scratch. So let's kick things off with a pretty crucial question. Why do we even bother with adjustments when we already have a finished trial balance? It's a super common trap to just assume your cash at the bank equals your actual profit. But in the real accounting world, we absolutely have to account for timing differences. We're talking about things like bills you owe but just haven't paid yet, or equipment that's losing value over time without actually draining your cash account today. Year-end adjustments are what fix those hidden gaps, so your true profit can finally shine through. Okay, so here's our game plan for today. We'll start with why these statements matter and look at standard formats. But then we are spending the bulk of our time on a real deep dive into the calculations before finally building our income statement and statement of financial position. Right, so starting off, why do these statements matter? And honestly, who's actually looking at your numbers? Well, before we start crunching the math, we really need to know who we're doing it for, right? Think of your financial statements as the ultimate business report card. On the inside, you've got internal users, managers who rely heavily on these numbers to literally run the day-to-day operations and make big strategic moves. But then, on the flip side, you have the external users. You've got prospective investors hunting for future dividends, banks double-checking if you can actually repay a loan, suppliers figuring out if you're safe to give credit to, and, of course, the government making absolutely sure your tax returns are legit. So yeah, from managers to banks, these reports are the undeniable proof of your business's health. Moving right along to the standard formats. Think of these as the blueprints of accounting. Knowing exactly what our final destination looks like makes the math journey a whole lot easier. Our first format is the Statement of Comprehensive Income. Honestly, I like to think of this one as your performance video for the entire year. It calculates whether you actually made a profit or suffered a loss during a set period. And how does it do that? By systematically pitting all your revenues against every single one of your expenses, from the raw cost of the goods you sold straight down to your monthly utility bills. And then we have the Statement of Financial Position. Now, if the income statement is a video, this one is a photograph. It takes a literal freeze-frame snapshot of your business at one specific point in time, usually the very last day of the financial year. It neatly organizes what you own, your assets, what you owe, which are your liabilities, and the owner's remaining slice of the pie, known as equity. All right, Section 3. This is where we get into the weeds. It's time for our calculation deep dive on year-end adjustments. So seriously, grab your calculators and maybe some scratch paper, because this is where the real fun begins. We are going to walk through the detailed calculations for Malika Jaya as of December 31st, 2020. Now, at first glance, their raw trial balance looks totally fine and complete, right? But wait, look closely at that extra list of additional information tagged on at the bottom. Those 6 little notes, those are the adjustments we absolutely must calculate before we finalize a single thing. If we ignore them, our profit is going to be completely wrong. So let's break them down detail by detail. Adjustment number 1 is our closing stock. The note specifically tells us the stock is valued at RM 620 at cost price, but RM 700 at market price. So, which one do we use? Well, strict accounting rules dictate that we must be conservative. We never ever want to artificially inflate our assets. So the golden rule here is incredibly simple. Always pick the lower value. We're locking in that RM 620 cost price and moving forward.
Next up, we have to tackle equipment depreciation. And notice just how beautifully simple the straight line method makes this calculation. We jump back to our trial balance, we find the raw equipment cost, which is RM 3000. Our note says we need to depreciate at 10% per annum using that straight line method. Okay, so RM 3000 multiplied by 10% gives us a nice clean RM 300. That RM 300 right there, that is our depreciation expense for the year. Simple as that.
Okay, moving right along to Adjustment 3, the provision for doubtful debts. Basically, this is just money we set aside because, let's be real, we anticipate a few customers are probably going to flake and not pay us. First, we locate our total debtors on the trial balance, sitting at RM 1300. The note tells us to adjust the provision to exactly 5% of debtors. So, RM 1300 multiplied by 5% equals RM 65. That RM 65 is our new target provision for doubtful debts. Finally, we have to adjust for timing, and honestly, this is the absolute heart of accrual accounting. We've got prepaid interest received of RM30 and prepaid commission received of RM25. Now, because these prepayments technically belong to next year's services, we have to subtract them from this year's revenues, otherwise we're totally overstating our current income. On the flip side, we have accrued utilities of RM40. We haven't actually paid this cash out yet, but we definitely use the electricity this year, so we owe it right now. Therefore, we have to add that RM40 back into our utility expenses. Section 4. It's time to build the income statement and finally find out our true profit. Now that all our detailed calculations are locked and loaded, let's start plugging them in. The top half of this statement figures out our cost of goods sold. First things first, we gotta clean up our buying costs. We pull our total purchases of RM 2,400 straight from the trial balance. But hey, we can't forget that we returned some damaged goods back to our suppliers. So we subtract that RM 130 for returns outward. That leaves us with a totally clean, true net purchases figure of RM 2,270. All right, so the next crucial step is getting to our gross profit. We take our net sales, subtract our total cost of goods available for sale, and remember that RM 620 closing stock we so carefully chose earlier based on the lower cost price rule? We subtract that closing stock at the very end. After crunching all that math, we hit our first huge milestone, a gross profit of RM 1,340. That's literally just what we made from buying and selling goods, nothing else. But we still gotta pay the bills, right? Next, we add in our adjusted revenues, making sure to subtract those pesky prepayments, and then we deduct all our operating expenses. This means adding in that RM40 for accrued utilities, and super importantly, including that RM300 equipment depreciation expense we calculated just a few minutes ago. Taking our gross profit, adding the adjusted revenues, and subtracting all these updated expenses leaves us with our ultimate bottom line, a final net profit of RM915. And honestly, it is so incredibly satisfying to see how all that beautiful math looks when it's perfectly formatted into the completed income statement. You can see the logical flow so clearly here. Sales minus cost of goods sold gives us gross profit. Add the revenues, less the expenses, and boom, we land smoothly on that RM915 net profit. Which brings us to Section 5, finalizing the financial position and balancing the equation. Okay, take a deep breath, because we aren't quite done yet. I need you to keep that RM915 net profit number right at the front of your mind, because it is literally the magic bridge that connects our first statement directly into our second statement. We take that RM915 and we inject it straight into the owner's equity section. Think about it. If the business made money, the owner's wealth naturally increases. If you miss this transfer step, your final sheet is never, ever going to balance. Now, as we start building out the position statement, notice how all those detailed calculations we did earlier reappear for one final bow. Over in current assets, our RM 1,300 debtors must be reduced by that RM 65 provision for doubtful debts we found. And those tricky timing adjustments, they slot in neatly too. The RM 40 for accrued utilities becomes a current liability because it's money we owe, while our prepaid revenues, like that RM 30 prepaid interest, are also treated as current liabilities because we technically owe a service for next year. So we list out our non-current assets, making sure to deduct the accumulated depreciation. We add in our current assets, and we total the whole thing up. Then we do the exact same process for owner's equity plus our liabilities. And, fingers crossed, if we did every single piece of math correctly and applied every adjustment with care, our total assets will perfectly equal our equity and liabilities at exactly RM $7,355. Here is the glorious final view. Honestly, seeing everything balance out perfectly at the bottom of this final sheet is simply the best feeling in accounting. It proves that every single transaction and every complicated year-end adjustment has been accurately captured and perfectly placed exactly where it belongs. So now it's your turn. We've just walked through all the mechanics step by step. Take a look at the review questions in the source notes regarding Al Hakim Holding Berhad. Can you apply exactly what we just did and calculate the depreciation on their RM $19,000 motor vehicles by yourself? But more importantly, I want you to ask yourself this. If just a few small timing adjustments can shift a company's reality this drastically, what kind of invisible stories are hiding in the financial statements of the businesses you interact with every single day? Remember, accounting isn't just about recording dry history. It's about uncovering the truth. Will your balance sheet tip, or will it balance perfectly? Thanks so much for joining me on this explainer, and happy calculating.